Every time you walk into a dealership or sign a commercial equipment contract, someone in that room understands the math better than you do, and they are counting on that gap staying exactly where it is. The lease versus buy decision is one of the most financially consequential choices most Americans make repeatedly throughout their lives. Vehicles, business equipment, commercial real estate, office technology. The choice appears in almost every major capital allocation decision, and almost nobody makes it with the actual numbers in front of them. The dealership wants to talk about monthly payments. The equipment salesperson wants to talk about cash flow preservation. The bank wants to talk about your credit score. Nobody wants to talk about the money factor. Nobody wants to explain what a residual value actually means for your wallet. Nobody wants to show you how to calculate whether the opportunity cost argument, the one that says lease so you can invest the difference, is mathematically real or just a sales technique dressed up as financial wisdom. Today, we are going to change that. We are going to build the complete mathematical framework from scratch. Real formulas, real tax code, real numbers on a real $50,000 asset. And we are going to show you what the ultra-wealthy actually do. Because, spoiler, they are not leasing and they are not buying in any way that looks like what your dealership is offering. By the end of this video, you will have a framework that works on every capital asset decision you will ever face, and you will never sit across from a salesperson feeling confused again. Let's start with the math that is being hidden from you in plain sight. Every time you lease an asset, whether it is a vehicle, a piece of equipment, or commercial property, the transaction is governed by three primary variables. Most people only hear about one of them. The first is the capitalized cost. This is the total initial value of what you are financing, the negotiated price of the asset plus any fees minus any down payment or trade-in credit. This is the number the salesperson is willing to discuss. The second is the residual value. This is the contractually projected market value of the asset at the end of the lease term. The difference between the cap cost and the residual is the depreciation you are agreeing to pay for the lease term. On a $50,000 asset with a 60% residual, you're paying for $20,000 of depreciation over the lease term. This number matters enormously, and almost nobody negotiates it. The third is the money factor, and this is where the deliberate obscuration begins. The money factor is the lease's implicit interest rate. It is expressed as a tiny decimal, something like 0.00125. Because it looks small, most consumers assume it is negligible. It is not. To see what it actually costs you, multiply it by 2,400. A money factor of 0.00125 becomes a 3% APR. Clear and understandable. But that is not what you are shown at the signing table. And here's the part dealers count on you not knowing. Lenders routinely mark up the money factor above the wholesale rate by 0.00050 to 0.00100. That represents an additional 1.2 to 2.4% in APR on your lease, generating undisclosed dealer profit on every payment you make. The monthly impact is small enough to feel invisible. The aggregate cost over the term of the agreement is significant. Once you know the cap cost, the residual, and the real APR hidden inside the money factor, your monthly lease payment is completely calculable. The monthly depreciation is the cap cost minus the residual divided by the lease term. The monthly finance charge is the cap cost plus the residual multiplied by the money factor. Add them together, and you have your base payment. Now, you can evaluate any lease offer before you sit down. But knowing how to calculate the monthly payment is only the beginning, because the real question is not what you pay per month, it is what you actually spend in total, and what you end up with at the end. And when you run those numbers on a real $50,000 asset, the result is genuinely surprising. The real numbers on a $50,000 asset. Let's run the actual math comparison. Same $50,000 asset, leased for 36 months versus purchased with financing over the same term. On the lease side, $2,500 capitalized cost reduction upfront, money factor of 0.00125, that's a 3% equivalent APR, residual value of 60% or $30,000. Monthly payment works out to $586.11. Over 36 months, plus a $395 disposition fee and the opportunity cost of that upfront payment, your total cumulative outflow is $24,557.50. At the end of 36 months, you hand the keys back. You own nothing. On the purchase side, $5,000 down payment, 5% APR financing, monthly payment of $1,348.45. Over 36 months, your total aggregate payments are $48,544. Add the opportunity cost of the larger down payment, and your total cumulative outflow is $54,669. But then subtract the $30,000 in asset equity you retained, the car or equipment you still own, and your net life cycle financial cost is $24,669. The difference in total financial cost between leasing and buying over 36 months on a $50,000 asset is $111.50. Let that land. Not thousands of dollars, $111.50 over 3 years. The monthly payment difference feels dramatic. The total financial cost difference is essentially identical when you account for retained equity properly. This is the number dealerships do not want you to calculate, because once you see it, the framing of the entire conversation changes. You stop asking which option has the lower payment. You start asking which option gives you more flexibility, more tax advantage, and more alignment with what you actually intend to do with the asset. Now, let's address the argument that almost every lease salesperson uses, the one that sounds the most financially sophisticated, and the one that the data shows is almost universally wrong in practice.
Here is the pitch you will hear in almost every leasing conversation. Lease instead of buy, preserve your capital, invest the difference. Your money works harder for you in the market than it does sitting in a depreciating asset. It is compelling. It sounds financially literate, and mathematically, in a vacuum, it is not entirely wrong. If you genuinely take the monthly payment difference and invest it consistently at a rate of return that exceeds the implicit cost of the lease, the NAL, the net advantage to leasing, is positive. The S&P 500 has delivered a nominal compound annual growth rate of approximately 10.4% over the past 30 years. If you could reliably capture that, consistently, every month, the math would favor leasing in many scenarios. But here's where the real world destroys the theory. Academic research by Brad Barber and Terrence O'Dean analyzing complete transaction-level brokerage data demonstrates that less than 1% of active retail investors reliably generate positive returns above the market after transaction costs. The most active traders underperform the market by an average of 6.5 percentage points annually due to behavioral biases, bid-ask spreads, and emotional decision-making. So the real question is not whether the math of reinvesting works in theory, it is whether you, specifically, will actually do it, consistently, without touching it, through a market crash, through a job disruption, through every temptation to redirect that money somewhere else. And the answer, for the overwhelming majority of people, is no. There is also a macroeconomic reality that the opportunity cost argument conveniently ignores. During 2022, one of the most relevant recent data points, the S&P 500 fell 18.10%, while the Bloomberg U.S. Aggregate Bond Index fell 13.01%. The traditionally diversified 60-40 portfolio lost 16 to 18% in a single calendar year. The money factor on your lease kept charging while your investment account was declining. The opportunity cost argument for leasing is valid exactly when markets go up, discipline holds perfect, and nothing unexpected happens. In the real world, it is frequently a rationalization for a higher monthly payment dressed up as financial strategy. The tax code changes everything for businesses. Now, here is where the math shifts dramatically and where the opportunity cost argument actually has real substance. For profitable U.S. business entities, the lease versus buy decision is not primarily about monthly payments at all. It's about the tax shield. Under IRC Section 179, a business can deduct the entire purchase price of qualifying equipment from its gross income in the year it is placed in service. For the 2026 tax year, that limit is $2,560,000. That means a business buying a $200,000 piece of equipment can write off the entire $200,000 immediately, reducing taxable income by that full amount in year one. For a business in the 21% federal corporate tax bracket, a $200,000 Section 179 deduction generates a $42,000 immediate tax saving. The effective net cost of a $200,000 asset becomes $158,000. No lease can replicate that immediate economic benefit. However, bonus depreciation is rapidly disappearing. Under the phase-down schedule from the Tax Cuts and Jobs Act, bonus depreciation was 60% in 2024, dropped to 40% in 2025, dropped again to 20% in 2026, and is fully expiring in 2027. The window to capture accelerated depreciation on purchased assets is closing. And for passenger vehicles, the numbers get complicated immediately. Any car under 6,000 pounds is subject to the luxury vehicle caps of Section 280F.